Welcome to The Explainer. Today, we're cutting right through all the daily market noise and zeroing in purely on the objective data for Medtronic. We're talking about the global medical device absolute behemoth trading under the ticker MDT. We're going to weigh both sides of the coin here, the bull case and the bear case, to figure out if this healthcare titan actually deserves a spot in your portfolio. And I want to instantly grab the attention of the income investors out there with this number right here, 49. That is the number of consecutive years Medtronic has bumped up its dividend payout. I mean, think about it. Through market crashes, recessions, a literal global pandemic, this company has consistently put more and more cash into its shareholders' pockets for nearly half a century. Okay, let's dive into this. Here is our roadmap for today. We'll start with Medtronic's status as a healthcare tech giant, then we'll break down their financial momentum, look at future growth, pivot over to the risks and headwinds, and finally get Wall Street's final verdict. Section 1, the healthcare tech giant. Establishing the scale. To really wrap our heads around the investment thesis, we absolutely have to understand their massive global footprint. Founded way back in 1949 and headquartered over in Ireland, this is not some small niche player. Medtronic employs over 95,000 people globally, but the stat that literally stops you in your tracks, their technologies touch the lives of 2 patients every single second. Tick, tick, 4 lives just changed. That is just an unbelievable scale of human impact. So how do they actually organize that massive reach? Well, Medtronic operates through 3 core business segments: cardiovascular, neuroscience, and medical surgical. And across those 3 massive portfolios, they're treating over 70 distinct health conditions. We're talking everything from pacemakers and spinal cord stimulation, all the way to AI-powered robotic surgery. Their revenue streams are incredibly diversified across the medical world. Section 2, financial momentum and dividends. The bull case. Right, so this is where we shift focus to the wallet-impacting data. Let's slow down for a second and just absorb these fiscal year 2026 results, because this is really the bedrock of the current optimism. Look at that top line, $36.4 billion in revenue. That's an 8.4% reported increase, which is huge, mainly because it's the highest annual revenue growth Medtronic has seen in a full decade. Operating profit clocked in at almost $6.5 billion, and on a non-GAAP basis, their adjusted earnings per share came out to a very robust $5.53. So you might be wondering, what on earth drove that decade-high revenue growth? Take a look at this massive surge. Global revenue for their cardiac ablation solutions shot up 78%. And actually, it gets even crazier. In the US alone, that specific category skyrocketed 124%. That let Medtronic snatch up 8 whole points of US market share. They are absolutely dominating this high-demand cardiovascular space right now. But here's the crucial part. How does this translate into returns for you? Just recently, on August 20th, 2026, the board approved a 72-cent quarterly cash dividend. When you annualize that to $2.88, investors are looking at a forward yield of about 3.09%. You know, in a market where finding reliable income can feel like looking for a needle in a haystack, snagging a 3% yield from a defensive healthcare giant is highly appealing. And this ties perfectly back to that hook from the very start of our explainer. Because of that 49-year track record, Medtronic holds the highly coveted title of an S&P 500 dividend aristocrat. Getting into this elite club means you've increased dividends for at least 25 years straight. Medtronic has nearly doubled that requirement. It just proves they are relentlessly committed to returning capital to their shareholders. Section 3, future growth and catalysts. Let's see what drives tomorrow. As we know, past performance is great, but the market is always asking what's next. We've seen a total flurry of strategic moves lately. Back in December 2025, they snagged key FDA clearance for their Hugo robotic-assisted surgery system. By March 2026, they spun off their entire diabetes business into its own IPO to really streamline things. Then in June 2026 came the Scientia Vascular acquisition, followed by that dividend lock-in in August. They are definitely not resting on their legacy laurels. They are actively reshaping the whole business. Let's speed things up and rapid fire through those M&A moves because this is where the growth happens. They dropped $550 million for Scientia Vascular to beef up their neurovascular care. They announced a $650 million buyout of SPR Therapeutics for chronic pain management. Throw in the CathWorks acquisition and that Minimed spinoff we just talked about. It's a highly targeted, aggressive capital allocation strategy to basically buy growth in high-margin sectors. And honestly, I think this quote from CEO Jeff Martha perfectly sums it up. We executed our focused portfolio strategy, targeting higher growth segments to accelerate innovation. He is laying it out plain as day. Medtronic is aggressively hunting down future revenue streams. Section 4. Risks and Market Headwinds. The bear case. Now, we've got to keep it real here. No investment analysis is complete without the counter-narrative. The hard truth? Medtronic's stock has underperformed the broader market, dropping roughly 30% over the last 5 years. Why? Well, one massive roadblock is surgical robotics competition. Medtronic is betting big on its Hugo system, but right now, in the US, it's only cleared for urologic procedures, so they are going head-to-head against Intuitive Surgical's Da Vinci platform, which is basically the undisputed, deeply entrenched industry standard. Unseating a leader like that, it's a huge, incredibly expensive uphill battle. And robotics isn't their only headache. Here is a totally unbiased rundown of the other bearish factors. First, execution risks. They've historically struggled with some supply chain bottlenecks. Second, the lawsuits. They recently went to trial on the first of thousands of cases over defective hernia mesh implants from their Covidian unit. Third, in June, an executive vice president was flagged for some notable insider selling. And lastly, they're currently eating about $185 million in assumed tariff exposure for the year. So yeah, there are some very real, tangible risks on the table. Section 5. Wall Street's final verdict. Consensus and price targets. So what are the pros doing with all this mixed information? This might be the most surprising takeaway of this entire explainer. Out of 27 professional analysts covering Medtronic, we're seeing 18 buy ratings, 9 holds, and 0 sells. Think about that. Even with the execution risks, the mega lawsuits, and a 5-year 30% slump, not one single analyst is telling you to dump the stock right now. Now, if we look at the actual price targets, the average is hovering right around $98.44 to $98.83. That implies a relatively modest 5.5% upside from where things currently stand. Now, full disclosure, that average target was actually revised downward recently from over $105, mostly because analysts got a bit spooked by some softer long-term utilization assumptions. But even with the haircut, the overall sentiment is undeniably positive. To put some names to those numbers for August 2026, let's look at recent actions by the major players. Citi is feeling bullish with a buy and a $110 target. Wells Fargo says buy at 102, Bank of America buy at 95. But then you've got JP Morgan playing it a bit closer to the vest. They've got a neutral rating and an $86 target. So it's a mixed bag, but definitely leaning constructive. Okay, so what's the next domino to fall? The very next major test for Medtronic is literally right around the corner. Their Q1 fiscal year 2027 earnings report hits on September 1st, 2026. That is going to give us fresh, hard data to see if that massive decade-high revenue momentum is actually holding up, or if those bearish headwinds are finally starting to take a bite out of the bottom line. Which leaves us with the million-dollar question. Is Medtronic the right defensive play for your portfolio before that September 1st report? You've got to weigh that legendary 49-year history of rock-solid dividends and explosive recent growth right alongside those fierce robotics battles and lingering legal headaches. The cards are on the table. Thanks so much for joining me for this explainer, and keep learning.